Hey everyone, and welcome back to the channel. Today we're diving into a gaming company that I came across. I'm talking about GRVY Company, Limited, ticker symbol GRVY on the Nasdaq. Now, you might not have heard of them, but you've probably heard of their most famous game, Ragnarok Online. GRVY is a South Korean game developer and publisher, founded in 2000 and headquartered in Seoul. They're a subsidiary of Gung Ho Online Entertainment and have a global presence with operations in the US, Japan, Europe, and Southeast Asia. While Ragnarok Online is their flagship title, their portfolio is pretty diverse. They've got PC and online games like Draganica and Ragnarok Landverse, mobile hits like Ragnarok M, Eternal Love and Ragnarok Origin, and even console games for Switch, PlayStation, Xbox, and Steam, including titles like Grandia and ALTF4. They're also using a one-source multi-use strategy to expand into other content like webtoons, merchandise, and even golf simulators. So why are we talking about them? It all comes down to their financials. Looking at the last 5 years, their revenue and net income have been pretty stagnant. Their free cash flow has been consistently positive, never dipping below $49 million. Now, let's talk about valuation. Their P/E ratio is just 7.7x. Their enterprise value is only about $32.7 million, but they're sitting on a massive net cash cushion of around $427 million. Think about that. Investors are essentially paying just $32.7 million for a business that generates nearly $50 million in annual free cash flow. This is a rare value proposition. This is also reflected in their EV to sales ratio, which is currently at 0.1x, based on a valuation that only accounts for their cash reserves, an EV to sales of 0. The target share price is estimated to be around $61. But if the EV to sales multiple just gets to a modest 0.6x, there's a potential upside to $90 per share. So, with all this value, why is the stock price so low? Well, there are a few reasons. Revenue concentration risk. They rely heavily on the Ragnarok franchise, which makes them vulnerable to shifts in gaming trends. Conservative capital allocation. Management has a history of accumulating cash instead of using it for share buybacks or dividends, which can frustrate Western investors. Ownership structure. Over 50% insider ownership means aligned interests, but also gives a small group a lot of control. So what's the bottom line? This is a high uncertainty, low risk opportunity. The investment thesis is to buy in at a price that's essentially valued only on their cash. The downside is protected by that huge $427 million cash position. And the potential upside could be a 50% gain to around $90 a share if the market starts to re-rate them. Potential catalysts for that change include new game successes, a shift in their capital allocation strategy, or the initiation of share buybacks or dividends. As always, do your own research. But hopefully, this gives you a good starting point to look at a company that's unique in the market. Let me know what you think in the comments below, and don't forget to like and subscribe. See you next time.